Welcome back to the Deep Dive. It is Monday, January 19th, 2026. And I have to say, looking at the calendar, it feels like we are living in a completely different era than we were just a few years ago.
It really does. The dust is finally starting to settle, isn't it? We've been through the whirlwind, and now we're looking at a landscape that feels, well, it feels distinct.
Distinct is a polite way of putting it.
Oh,
I was
yeah.
reflecting on this earlier. We are now fully 3 years post-ChatGPT.
Mhm.
Do you remember that initial launch?
I do. It feels like a lifetime ago.
It really does. And for the last 3 years, the entire narrative has been this relentless, just screaming AI boom. It was just buy tech, buy AI, don't think, just buy.
If it has a microchip, throw money at it. That was the philosophy.
Exactly. The rising tide lifts all boats phase. It was exhilarating, for sure, but also pretty chaotic.
But what we are seeing now, and this is really the core of our deep dive today, is that the tide is shifting. We've gone through this massive stack of 2026 outlook reports from the heavyweights. You know, Goldman Sachs, JP Morgan, BlackRock, Morgan Stanley.
All the big ones.
And the consistent theme across thousands of pages of analysis is that the narrative has fundamentally changed. We've moved from a buy the hype to show me the money.
And that is exactly why we are sitting down today. Because if you were listening to this and you're thinking about your nest egg, maybe you're retired, maybe you're getting close to it, or maybe you're just a prudent investor who values sleep over volatility, the playbook has totally changed.
It has.
You might be looking at your portfolio and thinking, okay, everyone is still shouting about robots, but how do I actually preserve my wealth in 2026 without getting completely wiped out by a correction?
It's the classic dilemma for the senior investor right now, isn't it? You
Yeah.
can't afford to miss the future, but you certainly can't afford to gamble the present.
Precisely. So we're going to unpack 3 massive shifts today. First, the death of the Magnificent Seven as a monolith. The band is breaking up, folks.
They're going solo.
They are. Second, the rise of something called agentic AI, which makes the chatbots we were all playing with in 2024 look like absolute toys. And third, and this is where it gets really interesting for our listeners focused on stability, we're going to talk about why boring investments are suddenly beautiful again.
Boring is beautiful. It's the return to fundamentals. We're seeing this huge rotation towards stability, income, and, real assets.
Okay, let's start with the big dogs then. The Magnificent Seven: Apple, Microsoft, NVIDIA, Amazon, Alphabet, Meta, Tesla. For years, they were the Beatles. They moved together, they sang the same tune, and they made everyone rich.
They did.
But looking at the 2025 retrospective and these 2026 outlooks, is the band actually breaking up?
The band isn't just breaking up, they're playing in different venues entirely.
Yeah.
That is the single biggest takeaway from all these year-ahead reports. The era where you could just buy a Mag 7 ETF or a generic tech fund and, sleep soundly is over.
It's over.
We are seeing massive fragmentation in performance. The correlation between these stocks is just dropping like a rock.
So we can't treat them as a block anymore. Let's get into the specifics then. Who is getting left behind? The reports seem to be pointing some fingers at Apple and Amazon specifically.
They are. Brahma Berkowitz from The Motley Fool, along with analysts from JP Morgan, they really highlight that both of them significantly underperformed in 2025. And there is a very specific, very thorny geopolitical reason for that, which I know you've been tracking.
You're talking about the Trump tariffs.
Exactly.
This has been all over the news, but let's drill down into the financial mechanic here. President Trump announced these high tariffs on major trading partners. Why does that specifically hurt Apple and Amazon more than, say, Microsoft?
It comes down to something very simple: physical supply chains. Microsoft primarily sells software and cloud services. They move bits and bytes across the internet.
Right, it's digital.
It's digital. Apple, on the other hand, despite all their efforts to move production to India or Vietnam, is still heavily reliant on manufacturing hardware in China. So when a tariff hits, it's a tax on the physical goods crossing the border.
So Apple has 2 bad choices.
2 very bad choices. They either eat that cost, which absolutely crushes their profit margins, or they pass it on and raise prices for consumers, which kills demand. There's no good way out.
And Amazon is in the same boat.
Similar boat, different ocean. Amazon's retail business is built on a simple premise: sourcing cheap goods from abroad, largely from Asia, and getting them to your doorstep fast. If the cost of importing those goods spikes because of tariffs, their retail margin, which is already razor thin, by the way, it just evaporates. The market is pricing in that risk right now.
So the political landscape is actually cleaving these tech giants apart. based on how much physical stuff they have to move across borders.
That's a perfect way to put it.
Now, what about Tesla? I feel like that stock is always a roller coaster, but the sentiment seems to have shifted from excitement to, well, worry.
I think worry is the right word. Tesla is in a category of its own, and not necessarily in a good way at the moment. The analysts are getting increasingly skeptical.
What's the main concern?
The consensus view in these reports is that it trades at far too rich a valuation. Essentially, the stock price assumes a level of success. Robo-taxis everywhere, full autonomy, that the current financials just aren't backing up.
This is price for perfection.
In a very imperfect world.
Yeah.
For a conservative investor, someone focused on that nest egg, the risk-reward proposition just isn't favorable anymore.
Okay, so if Apple, Amazon, and Tesla are the laggards, who are the holdouts, who is still carrying the torch for the Mag 7?
It's the companies that are deeply embedded in the corporate infrastructure of AI. Microsoft and Meta are viewed as the safer bets here.
Meta, really? I have to admit, I usually think of them as risky social media plays.
And that's fair. But in this specific context, they're viewed as safe because they have these diversified cash printing machines on the side.
Right.
Microsoft runs the corporate world. They own the operating system of business. Meta has a near monopoly on digital attention and advertising. So they aren't just relying on AI hype to pay the bills. They have massive cash cows grazing in the background to fund all their AI experiments.
That makes sense. That brings us to the king of chips, NVIDIA. Where do they fall in this? Are they a winner or a loser?
NVIDIA is the fascinating outlier. The experts describe it as a boomer-bust proposition for 2026. It is absolutely not a safety stock.
So it's a pure sentiment play.
It depends entirely on sentiment. If companies keep panic-buying chips, NVIDIA wins big. But if those companies pause for even 1 quarter to digest what they've already bought, NVIDIA could see a massive correction. It's a pure momentum play, not a value play.
This brings us to a keyword that I kept seeing in the JP Morgan and Goldman reports. And it's a phrase that should make every senior investor sit up and pay very close attention. And that phrase is concentration risk.
This is critical. I mean, if you take nothing else away from this deep dive, listen to this stat.
I'm ready.
Right now, the top 10 U.S. companies represent about 40% of the S&P 500's entire market cap.
Wait, 40. 40.
40%. That is a historic high. It is completely unprecedented.
So let me play devil's advocate here for a second. For decades, the standard advice for retirees has been just buy an S&P 500 index fund. It's diversified. It's safe. Are you telling me that's no longer true?
I'm saying the definition of diversified has changed right under our feet. If you own a standard S&P 500 index fund today, you are not actually diversified across the American economy.
You're just making a huge bet on tech.
You are taking a massive leveraged bet on just a handful of tech companies. So if there is a systemic shock to the tech sector, say a regulatory crackdown on AI or those tariffs hitting harder than expected, 40% of your safe index fund takes direct hit.
That is a very sobering thought. It means the set it and forget it strategy might actually be broken.
It's not necessarily broken, but it's certainly more dangerous than people realize, and we're seeing the professionals react. We even saw Rothschild & Co. Redburn downgrade both Amazon and Microsoft to neutral.
Neutral for Microsoft. That's a big call.
A huge call, and they explicitly stated we no longer see a bull case. Their core argument is that generative AI isn't going to be Cloud 1.0. It might not be the infinite money bringer everyone assumes it is.
That's a perfect segue. We've established that the chatbot era, the generative AI era, is kind of, well, it's 2024 news.
It is.
But technology moves so fast. What is the new buzzword for 2026? What comes after the chatbot?
The new frontier is agentic AI, or simply agents.
Agentic AI. Okay, help me understand the mechanics here. How is an agent different from something like ChatGPT?
Think of it this way. Generative AI, like ChatGPT, it talks to you. It creates text, it creates images. It's a content creator. It's like a very smart encyclopedia that can also write poetry.
Okay, that's a good analogy.
Agentic AI does things. It executes. It's the difference between asking a travel agent, what are some good hotels in Paris? And having that agent actually go book the hotel, negotiate the rate, buy your plane tickets, put it on your calendar, and then email your spouse the entire itinerary.
So it's action-oriented. It's not just giving me advice. It's actually logging into systems and moving money around.
Precisely. It's fully autonomous execution of complex tasks. And this isn't some far-off sci-fi concept. McKinsey is projecting that by 2030, this isn't just a niche tool. We are talking about a $1 trillion opportunity in the U.S. B2C retail market alone.
$1 trillion just from AI agents buying things for us.
Yes, because it removes all the friction from commerce. I mean, imagine a world where you don't browse Amazon for an hour looking for the right running shoes. You just tell your agent, I need a new pair of running shoes, size 10, under $150, good for high arches, and it goes out, it negotiates across the entire internet, not just on Amazon, and it buys the best option.
That sounds amazing for me as a lazy shopper, but I imagine it's terrifying for the companies.
It's creating a massive war for the rails. Think of it like the credit card wars of the 1980s. Whoever controls the protocol, the language these agents use to communicate and pay for things, wins.
So it's a standards war.
It's a standards war. Right now, we have a standoff. On one side, you have Google pushing their AP2, the Agent Payments Protocol. On the other side, you have OpenAI and Stripe pushing the ACP, or Agentic Commerce Protocol.
It's Visa versus MasterCard all over again.
Yeah.
Or maybe VHS versus Betamax for our listeners of a certain age.
That's the perfect analogy. And for you as an investor, this matters because the companies that control these payment rails, likely the Mag 7 or major fintech giants, they will capture a tiny percentage of every single machine-driven transaction. It's a brand new revenue stream that didn't exist 2 years ago.
But wait, I want to push on the employment side of this.
Yeah.
If these agents are doing all the work, what happens to the software companies? I saw a report from XTB that was discussing Salesforce and ServiceNow. If I don't need a human sitting in a seat using Salesforce because an AI agent is doing it all, doesn't Salesforce lose a ton of money? They charge per seat, right?
That is the big fear. It's the AI will replace software seats argument. And it's a valid one. If you charge $100 per user and you have fewer users because one AI is doing the work of 10 people, your revenue drops.
So how do they survive?
Well, these companies are smart. They see this coming. They are pivoting their business models away from per-user pricing and toward per-outcome pricing.
Per outcome. So they tax the productivity, not the person.
Exactly. Instead of paying for a license for your human salesperson, you might pay Salesforce a small fee every time their AI agent successfully closes a lead, or you pay ServiceNow every time an automated workflow resolves a customer complaint without human intervention.
So they get a piece of the value created.
A piece of the value. ServiceNow is actually seen as a potential winner here because their whole business is about binding cross-department processes. They are the glue. If agents are running the company, they need a platform to operate on, and ServiceNow wants to be that platform.
Okay, so that's the high-tech sci-fi future. We have agents fighting over protocols and buying shoes. But let's bring it back down to earth.
Yeah.
I'm thinking about the listener who might be looking at 2026 and thinking, you know what? I want stability. I want income. I don't want to bet my retirement on a protocol war between Google and OpenAI.
And honestly, you shouldn't. The senior strategy for 2026, according to Goldman Sachs and Morgan Stanley, is actually a pivot away from pure tech. We are seeing a major sector rotation.
But how do we bridge that gap? We just spent 10 minutes talking about how AI is going to eat the world. How does that possibly lead us to, well, to boring industries?
It leads us there because AI isn't magic, it's physical. All these agents require massive, massive computing power. That computing power lives in data centers. Those data centers generate immense heat and consume unbelievable amounts of electricity. So to have a high-tech future, you need old-school infrastructure.
I see it now. So the bridge is power and construction.
Exactly. We are rotating to industrials. Goldman Sachs is huge on this. We need copper wiring. We need industrial cooling systems for servers. We need updated power grids. Investing in industrials right now is the classic picks and shovels play. You aren't betting on which AI model wins. You're betting on the fact that all of them need electricity and air conditioning.
That makes perfect sense. So industrials are one pillar of this boring is beautiful strategy. What's another?
Healthcare.
Okay, why healthcare?
It's a valuation story, plain and simple. While tech stocks have been bid up to the moon, healthcare stocks have been relatively quiet for a couple of years. Their earnings are now catching up to their valuations.
That's defensive.
It's classic defensive positioning. People get sick whether the economy is good or bad, and right now the price you pay for that stability is right.
Okay, so industrials for the infrastructure, healthcare for the value. Now let's talk about income. For our retirees listening, fixed income is usually a staple. But for a few years there, bonds were, well, they were terrible. They're dead money.
Bonds are back. BlackRock explicitly calls them a stabilizer again. But there is a specific keyword that Goldman Sachs is highlighting for 2026. It's a term that usually only Wall Street traders use, but I think our listeners need to learn it. the carry opportunity.
Carry. Okay, help me visualize this. What does carry mean in plain English for someone who isn't a trader?
Think of it like owning a rental property. There are two ways you can make money on a house. You can flip it, buy low, sell high. That's capital appreciation.
Right.
Or you can just rent it out and collect a check every single month. That rent check, that's carry. It's the income you get just for holding the asset.
Okay, got it. Getting paid just for holding something.
Exactly. And Goldman is saying that right now, because interest rates are where they are, you can secure relatively high income streams, high rent checks from very high quality assets. You don't need to chase wild stock growth, flipping the house.
Yeah.
You can just collect the rent.
So what are we renting here? What assets provide this carry?
High yield credit and something called CLOs, collateralized loan obligations.
Whoa, hold on. You dropped an acronym there that's going to make a lot of listeners sweat. CLOs. That sounds dangerously close to the toxic assets, the CDOs, that blew up the entire economy in 2008.
Right.
Are JP Morgan and Goldman really suggesting that retirees should put their nest egg into that?
I'm really glad you pushed back on that because the distinction is absolutely vital. In 2008, those assets, those CDOs, were backed by subprime mortgages, junk loans given to people who could not possibly pay them back.
Okay.
The CLOs being recommended now are fundamentally different. We are talking about the AAA-rated tranches. These are senior secured loans to corporate businesses with real cash flow.
So these are loans to actual, functioning companies, not to questionable home buyers.
Correct. And the AAA rating means you are first in line to get paid no matter what. JP Morgan points out that so many clients are holding way more cash than they did pre-pandemic because they're terrified, but that cash is losing to inflation every single day.
Mm-hmm.
Carry allows you to put that cash to work in these safer income-generating vehicles. It's about moving from a checking account that pays nothing to a high-quality income stream.
Okay, that makes me feel a bit better.
Yeah.
So, AAA-rated credit for income. Now, I have to ask about the shiny yellow metal. I saw some absolutely eye-popping numbers for gold in these reports.
You did. Gold is usually the boring safe haven asset. But Goldman Sachs has a forecast that gold could hit $4,900 per ounce by the end of 2026.
And JP Morgan was even higher.
JP Morgan is even more bullish. They see it crossing $5,000. Roughly $5,055 to be exact.
$5,000 an ounce. That's nearly double where it was just a couple of years ago. What on earth is driving that? Is it just fear of a market crash?
It's deeper than just fear. It's structural. There are two main drivers here. First, central banks around the world.
Yeah.
Countries like China and many others are buying gold at a record pace, about 70 tons a month globally. They are actively trying to diversify their reserves away from the US dollar. They want an asset that no single government can print more of.
And the second driver.
Interest rates. As the Fed eventually starts to cut rates, real rates go down. Gold doesn't pay any interest, so when interest rates are high, gold is less attractive. But as rates fall, the opportunity cost of holding gold drops. It becomes the ultimate hedge against geopolitical chaos and currency debasement.
So gold is soaring.
Yeah.
What about oil? Usually commodities tend to move together.
Not this time. This is a big divergence. The forecast is for oil to stay weak, somewhere around $56 a barrel. So if you're looking for commodities exposure, the experts are shouting gold, not oil.
Very interesting. Before we move on, there was one other old school suggestion that stood out to me because it's a market that usually gets ignored by U.S. investors. Japan.
Yes, the Japan is a wild card thesis. Goldman Sachs is remarkably bullish on Japanese equities.
But wait a minute. Japan has been dead money for 30 years. I mean, stagnation, deflation, and aging population. Why would 2026 be any different?
It's a story of corporate governance reform. For decades, you're right, Japanese companies were notorious for hoarding cash. They would just sit on billions and billions of yen, effectively doing nothing with it. It was safe, but it was absolutely terrible for shareholders.
All right, no returns.
That has changed. The government and the Tokyo Stock Exchange essentially started shaming companies that were trading below their book value. They pushed and pushed for better returns on equity.
And it worked.
It's working. So now you have these huge, historic Japanese companies finally paying dividends, doing massive share buybacks, and actually caring about shareholder value for the first time in a generation.
Is this why Warren Buffett was buying up all those Japanese trading houses a little while back?
Exactly. He saw the shift before the rest of the crowd did. And now, with the Takaichi administration pushing fiscal support for defense and technology, you have a market that is relatively cheap, becoming more shareholder-friendly, and, crucially, is largely uncorrelated to the U.S. tech bubble. It's a great diversifier.
Okay, so we have our senior strategy. Industrials and healthcare for value, carry and bonds for income, gold for the ultimate hedge, and Japan for diversification. But we have to address the elephant in the room, the B word.
The bubble.
Is this 1999? Are we in an AI bubble that is about to pop and wipe out everyone's 401k? Because looking at some of these charts, the vertical line going straight up looks scary.
This is the central debate in the Morgan Stanley report. They do a great job outlining both the bull case and the bear case.
Okay, give me the bull case first. Why shouldn't I be worried?
The bull case is that this is a productivity supercycle. They argue that comparing this to the dot-com bubble completely misses the point because the technology is fundamentally deflationary and productivity enhancing. They point to things like NVIDIA's chips becoming 40,000% more energy efficient over time. The argument is that AI will boost GDP so much by making every single worker more efficient that these high stock prices will actually look cheap in retrospect.
Okay, I can see the logic. If one worker can suddenly do the work of 5, profits go through the roof. Now give me the bear case. What's the danger?
The bear case is what they call the CapEx conundrum, CapEx being capital expenditures.
Yeah, spending.
Big tech is projected to spend $527 billion in 2026 on AI infrastructure, chips, data centers, energy. $527 billion.
That is an astronomical amount of money. I mean, that's larger than the GDP of many countries.
It is. And here's the conundrum. Here's the problem. The revenue. Are they generating $527 billion in new AI profits?
No.
No, not even close. We are seeing what analysts call a mismatch. We are spending billions to make millions.
So the revenue doesn't show up soon.
Then the spending stops. And if the spending stops, NVIDIA's earnings crash. And if NVIDIA crashes, the S&P 500 takes a major hit. And on top of that, JP Morgan flags financial engineering as a major worry.
What do they mean by that? Sounds ominous.
It's this concept of circular investments. Imagine big tech company A invests $1 billion in a hot little AI startup B. It looks like a great venture investment.
Okay.
But then AI startup B turns around and uses that same $1 billion to buy cloud services from big tech company A.
Wait a minute. So it's just washing money. I give you $1, you buy a candy bar from me, and then I claim I made $1 in revenue.
Effectively, yes. It inflates the revenue numbers on both sides. It makes the ecosystem look incredibly robust, but it's actually fragile. If that venture funding dries up, the revenue evaporates instantly because there was no real external customer in the first place.
That feels very bubbly. It reminds me of the dot-com days where companies would just swap ad space with each other to book revenue that didn't exist.
It's a valid concern. It doesn't mean a crash is imminent. These bubbles can last a long, long time. But it means the easy money phase is definitely over. You can't just blindly trust the revenue numbers without looking at where that money is really coming from.
So, we've covered the split in big tech, the rise of agents, the safety plays, and the bubble risks. Let's bring it all home. What are the actionable takeaways for our listener? If I'm sitting down with my financial advisor tomorrow, or maybe my agent, what am I asking?
First and foremost, diversification is no longer a buzzword. It's a survival strategy. BlackRock's advice is crystal clear on this. Advisors are underweight tech, but the type of tech you own matters. Don't just buy the index, and you need to look beyond the U.S.
International equities, like Japan, as we discussed.
Yes, and emerging markets. India is huge for digitization. Taiwan for chip manufacturing. TSMC is the absolute backbone of everything we've discussed today. If you are 100% in U.S. stocks right now, you are taking on far too much concentration risk.
And what about this idea of private markets? Usually when I hear private equity, I think closed to regular people. I think of billionaires and hedge funds.
That's rapidly changing. JP Morgan is really pushing this. They suggest looking at private markets because the application layer, the companies that will actually use this AI to do cool stuff in the real world, they might stay private for much longer. They aren't going IPO as fast as companies used to.
But how does a regular person, say a retired dentist, actually buy private equity?
The mechanism has been democratized. You don't need $10 million anymore. There are now things called interval funds and specific ETFs that hold portfolios of private companies. There are platforms that allow accredited investors, which many retirees qualify as, to get exposure with much, much lower minimums.
So it's something you can ask about.
It's definitely worth asking your advisor, do I have any exposure to private growth, or am I only buying what's on the public stock exchange?
And finally, the strategy that seems to tie it all together, you called it the barbell.
The barbell approach. This is perfect for the senior investor who still has a little bit of FOMO, fear of missing out, but needs to be able to sleep at night. Visualize a barbell. On one side, you have heavyweights. On the other side, heavyweights. and nothing in the middle.
Okay, so what's on the left side of the barbell?
The left side is your high-risk, high-growth AI exposure. Maybe you own Microsoft or a semiconductor ETF. You keep that there because you can't afford to miss the transformation if this productivity supercycle turns out to be real.
Right, you don't want to be on the sidelines if this really is the next industrial revolution.
Exactly. But you balance that heavyweight on the other side with extreme stability. Gold, bonds, high-dividend healthcare stocks, the boring stuff.
So you completely skip the middle.
You skip the mediocre middle. You don't buy the companies that are kind of into AI but are kind of struggling. You buy the clear winners and you buy the ultimate safety net. That way, if the AI bubble pops, your golden bonds are there to catch you. If the AI boom continues for another 5 years, you get to participate in the upside.
That makes a lot of sense. It sounds like active management is the big theme here. The days of set it and forget it are numbered.
Passive indexing works great in a bull market where everything just goes up together. But in a fragmented multipolar market where Apple is down but Nvidia is up, or where gold is up but oil is down, you need a human or a very smart agent picking the specific winners and avoiding the losers.
So to sum it all up, 2026 is the year of selectivity. The Magnificent Seven is fragmenting. The robots are starting to shop for us. And the smart money is moving into gold, bonds, and the companies that build the physical world.
That's the summary. The easy money is gone. Now we all have to be smart money.
I love that. Before we sign off, I want to leave the listener with one final, slightly provocative thought that came up while I was reading these reports. It goes back to that agentic AI.
Let's hear it.
We talked about agentic commerce. The idea that an AI buys your stuff. If I tell my agent, buy me paper towels, and the algorithm decides which brand to buy based on pure efficiency price per sheet, absorbency data, shipping time, what happens to brands?
That is the multi-billion-dollar question, isn't it?
I mean, does advertising even matter anymore? If I'm not looking at the grocery shelf, I don't see the colorful logo. If a company like P&G or Unilever spends billions on TV ads to make me feel emotional about soap, but my AI agent is just buying the generic version because the data says it's a better value, does the entire consumer economy break?
It forces a massive shift from brand loyalty to data loyalty. Companies will have to optimize their products to be chosen by algorithms, not by humans. It changes everything about how companies make money. And for you as an investor, you have to start asking, which companies are ready for a world where their customer isn't a human but a piece of code?
Something to mull over while you check your portfolio balance. Maybe call your advisor and ask out that carry opportunity and whether you have enough boring in your barbell.
Definitely worth the call.
Thanks for listening to The Deep Dive. We'll see you next time.